Interest rates are so confusing. Everyone knows the rate, but few know its importance and who decides on it. What are the different ways it can be computed? How does a bank determine an interest rate? If you don't know how to calculate interest rates, it might not be your fault. Interest rates have made up a considerable part of our day-to-day lives, and most people don't even think about them because they're too complex. What is the impact on an individual or on a society? I will discuss all of this in this video by providing you with 6 easy-to-follow points to help you become more knowledgeable in the field of interest rates. Please make sure you watch this video until the end, and do not skip any part so that you don't miss out on those 6 points that could potentially change your life. Also, please give it a thumbs up. Don't forget to subscribe and turn on notifications. Point number 1. What exactly is interest? Interest is the money generated through investing or lending, as well as the money paid while borrowing. It is stated as a percentage of the principal amount, such as 10% each year. The country's central bank determines interest rates. Point number 2. Who determines the rates? In the USA, Federal Reserve Bank, Fed, determines the central lending rate at which banks borrow from them, which influences the interest rates that banks provide to the general population. By analyzing economic developments in relation to government aims, the central bank attempts to boost or restrain the economy through monetary policy, increasing or decreasing interest rates. This implies that Federal Reserve Bank, Fed, determines the prime lending rate in order to affect the direction of the national inflation rate and exchange rates in order to benefit the U.S. economy. Point number 3. Different types of interests. The many forms of interest may be divided into 2 categories: compound versus simple interest, and adjustable versus fixed rates. Simple interest is a notion that is rarely utilized in the financial sector and is something that one could learn in high school. For example, if you earn 10% per year on a $100 investment for 5 years, you will earn $10 every year for a total of $50. Compound interest is also stated as a percentage, say 10%, but it is computed on a larger initial amount each time. If interest is compounded per period, for example, the investment earns 10% the first month, as with simple interest, but 10% on a total of $110 in the second period, $100 plus the $10 interest portion. The third period is 10% of $121, and so on. Compound interest is commonly used in financial circles and is generally compounded monthly. On liability products, the financial industry, particularly debt providers, offers either adjustable or fixed rates. Adjustable rates fluctuate in response to changes in the central bank's interest rate, and if increased, for example, increase the monthly interest charges payable. It is tied to the central prime lending rate, for example, prime plus 1%. Adjustable rates can be beneficial if rates fall during the liability requirement period, but they might be burdensome if rates rise over time. Fixed rates remain unchanged for the entire duration of the liability, for example, 10% per annum. Real quick, if you guys are enjoying this video, which I put a lot of time and energy into, I would really appreciate it if you guys tap the like button and make sure you subscribe with notification on. And if we get 2,000 likes on this video, I'll drop a brand new video next week about the same topic. Now, let's get back to the video. Point number 4. Inflation. The relationship between the interest rate and inflation seems interesting. Continuous price increases, inflation, have the net impact of devaluation. The same things are more expensive a year from now, but provide the same advantages. Consumers and manufacturers both complain about the decline in the value of money, because inflation impacts raw material prices as much as it does finished goods and services. Products on the shelf become more expensive to produce. Inflation, when kept under control, encourages economic growth. Federal Reserve Bank, Fed, has an inflation goal of 1% to 2% each year. However, excessive inflation devalues goods and services, reduces borrowing to dangerous levels, and discourages saving, because there is less disposable income as the cost of living increases. When inflation is too low, the reverse happens. Growth stagnates, So, some inflation is beneficial, but not excessive. We don't want to wind up like Zimbabwe and Venezuela. The interest rate influences inflation by either increasing spending if rates fall, which promotes consumption and creates economic growth, or lowering borrowing, which reduces disposable income, which has the reverse effect. Again, that's only true in moderation. Point number 5. Advantages and drawbacks. Any increase in interest rates may be an unprecedented disaster for the majority of the local people, but there are a variety of benefits for lenders, creditors, and investors. Developed countries have minimal inflation and provide lower interest rates due to established economic growth rates. Before entering into any financial commitment, smart borrowers, debtors, confirm that the interest conditions are favorable. This includes ensuring that the interest rates given are in line with the industry average, comprehending the implications of adjustable rates, and being fully informed of the consequences of repayment default. Before I present you point number 6, comment down below, "I am from AKA, your country." In that way, I will know exactly where you're from. So in the future, I can make sure that every single video I release is meant for you. So drop your country's name in the comments down below. And make sure to watch this video until the end. And do not skip any part so that you won't miss out on those important tips. Now, let's get back to the video. Point number 6. Interest calculations. A practical example is sometimes the best way to illustrate. So pretend you're in the market for some new furniture. It is feasible to pay in cash at the start. Other possibilities include signing up for a 5-year repayment plan with the furniture business, or taking out a short-term loan and paying cash for the item. The usual interest rate for a short-term loan is prime plus 1%. The repayment period is 2 years. The furniture shop repayment plan has a monthly installment of $103 based on a 10% interest rate, compounded monthly. This remains constant during a 5-year period. Both loans require an initial $150 down payment. What is the cheapest way to finance the furniture if the prime rate is presently 9% and will rise to 10% in 3 years? If you said short-term loan, you could be a smart borrower after all. The furniture shop payback plan would cost $6,180 in total, $103 over 60 months. The entire amount of the short-term loan is $5,352, paid over 24 monthly payments. The adjustment in the prime rate would not have affected the short-term loan because it was paid off before 3 years. Paying in cash will cost $5,000, the least expensive of the 3 payment alternatives. If possible, pay in cash initially, but if financing is the only choice, shorter payback terms at comparable interest rates are the way to go. Interest rates have an impact on our lives on a daily basis, from the goods and services we purchase and sell to the payment plans we hate. The way interest works is not a mysterious process. Anyone can have a rational discussion about the advantages and disadvantages of an interest rate. Please give it a thumbs up and share your opinions in the comment section. I would love to hear them. That being said, don't forget to subscribe and turn on notifications. Now, if you want to watch more videos like this, then you need to watch this video right here. This video is one of the best on this channel.